All right, good evening, guys. Kind of Tortoise Capital nightly strategy podcast for Saturday, January 14th, 2023. So we'll be looking at swing trades here in a minute. I had a nice post here from Griff, who's on board. So want to review his evolving trading plan here. I should also say that he and Phil have turned ablewaytech.com into a nice little website here for their sniper support package. Essentially, it's a Thinkorswim bundle that has coded all our indicators for Thinkorswim, and have done a really nice job of systematizing the teaching of the Kata 2 challenge, and I endorse their work. It's really well done. And I think what they're doing is showing that the best way to learn something is to become professional about it and uh, learn to teach it so that you can learn your own materials. Whether you actually teach it or not, it's being prepared to teach it is what really makes a difference. So we're going to check his evolution here, Pokemon evolution. He's going from the existing Kata challenge, which was to use three basic patterns: the supported spring crossing, the collapsing dragon, and the Kata 2, each traded one at a time on two specific symbols. And then his setup would be whichever pattern he was trading that day every time it came up. So we were using that as a way to really master those three different patterns. In a nutshell, those require a movement of price from some level, a significant move downward, and then a reversal. We need that to be a harsh winter if we were looking at the MACD histogram. It needs to be at least 1.5 frog boxes, which works out to be about 3 mmRBs. The way we have constructed that, when you use the R10 as the mmRB, which is 1/10 of a range stat. It turns out that if you get a move of this magnitude from, say, the top of this mmRB box, and it goes 3 mmRBs to the bottom, that turns out to be about 1.5 frog boxes. And then what that gives you is 4 levels of price chunk, so that if you do get the reversal here, if you do get that reversal, uh, and you wait for it to move one frog or one mmRB off that low, and get your entry with a stop here, which is intended to be a collapsing dragon. If this whole effort fails, you get a collapsing dragon. But if it doesn't fail, and you get an entry, you get you can plan on 1, 2, 3 mmRBs back to the top of the resistance, meaning that if all you get is a movement to the bottom of the resistance and it starts to fail, you still get 2 units of reward against 1 unit of risk. And so it turns out that a significant move like that now creates a channel that is wide enough from RL10 pivot to RL10 pivot that you can actually use the mmRB as a framing device, and that allows you to get enough reasonable price action that if it just returns to the previous resistance, that you'll get a tradable channel. So what Griff has been doing has been trading whichever one of those three patterns he really wanted to concentrate on, and his goal was to trade that pattern every time it came up so that he could master the nuances and the details and the repetition of one of those three patterns. What he's looking to move towards is the idea of finding the mover. So now what that means is he's got to have a stack of symbols, more than just EWZ and DIA, but he really is looking at reliable, consistent movers. This is a set of frog champions which move reliably intraday, and so now he's got to have a mechanism where he has that on a watch list by symbol, and then he can take a look at the percent movers, the percent that it's moving, and then have a means on his trading screen to have multiple screens going so that he can pick something like, let's say, SPY always on his screen as a way to view the market. He might have VXX on there to always check the volatility. He might have IWM on there to watch the small caps. He might have EEM on there so that he's ready for the globals. That might otherwise be EFA, but EEM is a little better. And then he might have something like a sector that really works, like XLB, and then maybe either Alcoa, US Steel, or Cliff. Whichever one of those three is moving the best, he might now be able to put that one on there that's moving so that he can tell at a glance market, sector, and the mover in reference to each other very quickly. And then he might have a couple other symbols over here that he's stalking, like he might be interested in energy, Devon. He might be interested in Mexico, like always, or EWZ. So now what he's got is his to-do list, if you will. And then if the market is up and he sorts by the percent gained, that would put the biggest winner at the top, and that might be the one that's moving the best, and so he would put that down in here on a screen, and then he could manage that. And then he'd have at the bottom the things that were the biggest losers, and well, those might be the ones that end up giving him that reversal into the SSC. So having his watch list sorted gives him the ability to find the movers and then get them onto a tactical screen. And then he might have a big screen where however big it needs to be, so he could see enough information on there to make his decisions. So this idea of finding the movers means that he's got to have some plan that allows him to manage a population. You know, think of that as a bunch of cows moving along in a herd, and you got to have your little cowboy over here who's watching that so he can see who's moving, who's not, and he can find the outliers and trade them. So finding the mover also really means managing the mover, and he's got a nice set here. He's got Alcoa, Cliff, and US Steel as the metals. He's got Devon for energy. He's got the two indexes, the non-US European indexes, Brazil and Mexico. He's got the conservative DIA that he's already comfortable with. And then he's got Tesla, the most important stock in the world. So he's got a nice population, an initial population of movers to work with. So that looks pretty solid. And now in terms of patterns and skills, instead of working on three patterns in isolation, he's looking to do chain trading, in which the baseline SSC, supported spring crossing, when it works, can then also lead to kata 2s on the long side. And the SSC when it fails, leads to a chain of collapsing dragons and then kata 2s short. So what's that look like, the two scenarios? Well, if we start with the proposition that there was some consolidation and then there was a fail into the harsh winter, now we know that this thing is in play. Because of the magnitude of it. Like I said, that needs to be probably 3 MMRBs or 3 MMRB or 1.5 frog box, so that this is a significant move away from the previous support. Then this thing is going to base and reverse enough so that if we were looking at this through the, as we would, through the lens of the RL10, it reverses like that. So there's got to be enough of a rebound in price so that we get an actual turning point in the RL10. And the way the math is constructed, that always comes to a sharp point. And then we know that that little sharp point is going to lead to the PSAR flip. When the PSAR does flip, you know, this move that was coming down is going to feature a PSAR trend line that looks like that. And then when you get enough of a rebound that makes the SSC possible, the PSAR is going to flip, and the flip always occurs at the belly of the RL10. And so he's going to build his risk box. He's going to get his SSC entry. He's going to have his collapsing dragon signal right here. And what he's looking for is that when the SSC works, this should lead to again a pullback, and then a series of kata 2s that leads you from SSC to kata 2 to kata 2. Now in each of these kata 2s, these little regions, there's enough of a pullback and then a reversal where you can see a higher low in the RL10. And so these little kata 2 moments either become re-entries because maybe this move was big enough that you exited in here, but then it held and it reversed. So a kata 2 is either going to be a re-entry or it could also be a second position. Because if this R10 wiggle was not enough to get you out and then it resumes, then you can look at that as a confirmation of the trend and starting of the next leg. So we will look at the top of that RL10 where that peaks. We're going to draw a line across there, and we're going to draw a line at where the base of the R10 reversed, right? So if I can draw this R10 in yellow so you can see it. So when that R10 price comes up and peaks and then comes down and then reverses, you end up having this little shape here. So any entry or any re-entry that's in this orange region here, or let me put it this way, that's between the peak of the R10 and the belly of the RL10, that's going to be any entry in this region here inside the channel between those two lines is going to be a pocket entry. If he waits for it to get above the peak of the RL10 and buys it here, then that's going to be an emerging dragon entry, which is fine. It just means that you're waiting for that extra confirmation. So that could be the difference between entering in the pocket or entering up here, and that might be a half of an R of extra gain. If this works, you get an extra half of an MMRB because you got the better entry. But you don't get the confirmation that it's working, which some people need for confidence, until it breaks above the peak of the R10. The main point is that it's holding here, and now the price has come into the pocket and then taken off. All right, so when those things are moving to the upside, and it starts with your SSC, then that could lead to a series of kata 2s all the way up, and those are either going to be re-entries or adding a second or third position, and it creates a chain. It creates that the big sell-off, and then an SSC, and then a series of rising, climbing up the stairs. And as long as it's staying above the the PSAR dots, every one of those little pullbacks becomes an opportunity for a kata 2. And again, the main idea is that if that's the RL10, that if you wait for it to emerge from higher than the previous peak, then your entry up in here is going to be an emerging dragon. If this rolls over and doesn't take that out, then you have an opportunity for a collapsing dragon. Now, why would you wait for the emerging dragon? Well, you might wait for the emerging dragon because you want to see some evidence that this price action is actually continuing, that it's beaten the previous peak, and now we got new buying power that's buying it at a price higher than it peaked at before. Whereas if you're in the pocket, you still don't know if it's going to break through that resistance yet. And if it doesn't break through the resistance, it might lead to this kind of failing price action that leads to a collapsing dragon. Remember, the size of this region is probably just a MMRB anyway. So if you do enter inside this area here between the peak and the belly, we think of that as the yellow zone, that until it breaks above the previous peak, it's not in the green zone yet, where you want to belong. And if it hasn't broken below that line of the RL10 is the red zone, and that's collapsing dragon territory, and you want to be short there. So while you're in the yellow zone, you are trading in a region of maximum uncertainty. And again, if the previous trend was strong enough and you're able to enter in this yellow zone, then you're already in position and you've made this little box. Just as it breaks out, what will typically happen is that the breakout above that previous RL10 peak will really go. And if you wait for that to happen, then you may be chasing and you get a bad fill. Whereas if you had entered in this zone, as soon as it crosses the dragon, let's say, then you're making bank on this, and then during the burst of energy to the upside, all you have to do is get your stop above your entry, and now you've locked in that extra gain. So that's the nuance of the chain trade, in which you don't get a kata 2 until you had a successful supported spring crossing, which is now pulled back a certain distance. And now is the chain going to continue up? And that can be many multiples of kata 2s. It is typical to see that kind of climb up the steps behavior. And we're always being very careful to manage our stops through there, because while it is slow in climbing the steps, when it breaks, it jumps out the window. And that's the main logic behind the idea of the collapsing dragon, that when these support levels collapse, that all of the optimism that was feeding this collapses, and then fear takes over, and then all those guys get out. And so the collapsing dragon is actually our favorite pattern because of that phenomenon, that when it goes, that first move is large. It turns out that there's enough SSCs that work that lead to kata 2 chains that you want to be ready to trade that. Now, the other pattern and chain that he wants is on SSCs that fail, leading to collapsing dragons and kata 2 short. So that one looks like this, that there was some price action up here, and then there was the harsh winter, which has now resolved into the SSC, because the R10 peaked and then took off. So in this chain, what he's done is he's going to be looking for those moments where the SSC triggered and then price fails, and he takes the collapsing dragon. And then the collapsing dragon tends to look like this. Big moves down, short recoveries, and then collapsing down and collapsing down. And in each case, whatever the belly of the RL10 is, he draws that line across here. And then at the collapsing dragon, he looks to add a position or to recover. Because if he's short on the collapsing dragon, this little rebound may be enough for him to lock in his gain. He only wants to give back a little piece so that he can collect a nice large R multiple. So maybe the rebound was enough that it triggered an exit. But then instead of continuing up like an SSC, maybe that thing just fails, and now he gets a kata 2 with the collapsing dragon, and he gets these little chains all the way down. And you've seen us do that a lot. That is really a strong pattern, because the fear that's engendered in here, that downward trend, is more powerful than the greed that works on the way up. So what he's going to learn here in this little effort is that that when he gets those SSCs, those represent very important intersections. The hybrid or the harsh winter move that led to the SSC means that the pattern is in play, that symbol is in play. And you're either going to get a successful SSC that leads to kata 2s, or you're going to get collapsing dragons that could lead to more kata 2s to the downside. So he's going to be focusing on taking those individual patterns and learning how they work out of that critical state in two directions. This is really the same idea that we use in the compound critical state idea for the sniper. Is that in the sniper strategy, we've got some kind of price action that has led to a compound critical state, and from that compound critical state, we're entitled to expect large moves in either directions once that tension is resolved. So if we can put a nice tight risk box around that, then we're going to get multiples of that if it breaks to the downside. And that would feature patterns like kata 2 and collapsing dragons. But if it breaks out to the upside, then we're entitled to expect large multiples of that move. And we're just waiting for the compound critical state to break. And which way is it going to break? I don't know. But when it moves, it's going to be large. So there is a strong connection between the main ideas of the sniper and this chain trading using the basic patterns that he's working on. So the other thing he's going to learn is going from the one particular pattern he was going to feature, waiting to see that the initial conditions of the frog box move from a PSAR flip and then a tradable channel has occurred. In other words, he wants to see that the thing is in play. And so what we're looking for again is when price has been in here and it makes a harsh move in one direction, that the size of this move is so large that it is clearly in play. And now when the SSC reversal happens, there's a potential for a nice move in either direction. If you are trading inside a tight channel, you may see little PSAR flips like this, and they never go anywhere. It's because you're trading inside a sideways quiet channel and it hasn't made the big breakout, which tells you that it's in play. So if you really want to optimize this idea, you gotta wait to see the harsh winter. You got to wait to see the move that tells you that enough players are in here playing. In this case, the harsh winter tells you that the bears just won. That there was enough people looking to short that and not enough people to buy it, that price responded with a significant directional move. That raises the stakes. That raises the energy. It makes the bears hungry to get more Kata 2s and collapsing dragons to the downside. It makes the bulls come in and they see that and say, oh, I can now start buying this thing on sale. I can buy it at this level instead of that level. And then as long as there's enough of a move to the upside, they can say, I can buy that thing on sale and just get the retracement back to resistance. And that's what brings the bulls in. So what you really want to have big moves is a heightened state of emotionality of both the bears and the bulls. And that's what the SSC condition, that's what the compound critical state condition creates, is the heightened state of emotion that makes the herd start to stampede in either direction. In fact, the least likely occurrence is that when price comes down out of that harsh winter, the least likely thing is that it stays right at that perfect channel and doesn't break in either direction. That would be the least surprising thing, where it just kind of stays in here. Because that harsh move down there, what, they got it right exactly, and now everybody agrees that this is the new rational price? That's unlikely. That is more likely to create a feeling that I can buy it on sale, or that more pain and suffering is coming. So that harsh winter creates the compound critical state that we want. So that's the chain trading that Griff is looking to do. What he wants to make sure remains constant is his use of managed risk using either the R10 or the R6. So for us, the R10 it is simply the range stat divided into 10 segments and then picking 1/10 of the range stat. And then the R6 is simply the same idea, that you take the range stat and then you divide it into 6 segments. It still uses the same principle. It's just that the size of the box is different. You know, the R6 is almost twice the size of the R10. So 2 R10s is almost an R6. I mean, if it was an R5, it would be perfectly 2, but you get the point. We've seen the case in some places where, you know, the width of the R10 box is just a little bit too narrow. We're going to see that in Dan's like hybrid swing trading here, where the risk box he's chosen is not as wide as the PSAR flip, and there were some noise exits that hit. So the main thing is that Griff is looking to continue to use a very disciplined and structured managed risk, that he's going to be concentrating on an exit strategy that make him satisfied and confident that he's trading in a professional way. Because the exit strategy you take is always a trade-off. That if I've got a gain and now it's pulled back this far, and now if I make a decision to get out here, you got to remember that's always going to be framed in a box of uncertainty that looks like this. That says, well, if I get out here, well, what if it just reverses and goes, and then I got out too soon and I didn't give it enough room? Well, that's where having a re-entry strategy like his Kata 2 or the emerging dragon says, look, if I get out here and it reverses, then I'm going to get in here if I can still see 2 to 1 to the upside. So I've already reframed the entry when I've decided that I'm going to get out here. And then you say, well, if I don't get out here because I'm worried about missing the continuation, I'm really running the risk of getting to move all the way back to where I first got into this thing. And now if I get out where I got in and I scratch the trade, then I'm going to beat myself up because instead of taking a rational move to give back 1, I ended up giving back 2 more. So one of the ways you can look at this whole idea is that if I've locked in some kind of gain, and I needed a 2 to 1 reward to risk ratio to justify the trade in the first place, maybe I could do something as simple as dividing that into threes and say, if I give back 1/3, I'm preserving the gains on 2/3, and then as long as I have some method of getting back in, if this thing reverses immediately and starts going, as long as I have a way to get back in, then I have taken a professional management decision to give back 1 in order to preserve 2. Now, there might be some other ones. Like this move might have been so far that to give back 1 MMRB, which is how much risk you took on the front end, you might actually be protecting 4, and you say, well, if I've made money on this move, and if it's more than an average win, well, this is something else he's got to figure out, is he's got to go back because he's trading in sets, and he knows the characteristics of his trades. He's got to know that for that particular pattern on an SSC or a Kata 2, what is the average win that he has? What's the average? So if he's in a trade and this thing has moved past the average and he's up in here, he should have a rule set, an exit rule set that says, no matter what, if I'm in this region of an above average win, I'm not going to let it cross the line and become a below average win. So that gives him the choice of deciding, hey, maybe I exit at 1 MMRB, but as long as I don't let the above average win become a below average win, then I'm giving it room to resolve to possibly go higher. But what you cannot afford to do is to let an above average win become a below average win. So as he's developed his exit strategy to make himself satisfied and confident, he's got to contend with a personalized exit strategy that makes him personally feel professional. So that means that he's got to go through and identify, what does it mean personally to be professional? What does it mean to be professional? And then how does it feel to feel professional? And then when you know what those feelings are like, and you desire to have those feelings, and then you have a set of rules for exit, and then you commit to those rules, and then when you perform to those rules, because you've defined that as being professional, that when you see yourself being professional, you will then feel professional, and then the positive feelings of feeling professional will reinforce future implementation of professional rule sets. So there's a very virtuous cycle in there. And remember that the professional rule set is one that's designed to keep you in the game. That means it will not allow you to risk everything on one trade and blow up your whole account. So professional rule sets mean that you're going to be in the game for the long run for the next 1,000 trades. So you've got to have rules that allow you to do that, preserve capital. And it has to allow you to make trade-off decisions. What do I mean by a trade-off decision? It's the same one, that you're in the trade and you move to here, and then you're deciding, do I exit here knowing that it might go this way or further? And there's a trade-off. How long do I stay in a winning trade to give it room to continue? And when do I cut it short in order to preserve the gains? That is a trade-off decision. There's no one perfect answer for that, although every time you look backwards at individual cases, you will find reasons to punish yourself. There will be times when you got out here, and then you see it turns around and immediately goes, and you didn't get back in, and you say, aha, well, you see? Or even if you got in, you say, hey, I exited here, and then I got back in here, and now I missed out on that. So next time, I'm not going to exit here so that I don't lose that little sliver, and then that's the one that collapses. So when you look in retrospect in an emotional way, trying to punish yourself for making the wrong decisions, then you'll always concentrate on the ones that you did wrong, not on the ones that actually did what you wanted them to do. And you will use selective memory to shape. And that's why you got to use stats. That's why you got to take a look at all of your trades and your trade performances in a bundle that all use standard rule sets. And then you put the stats on it and you find out what that average win was. And then you can take a look at the exit rules that said, hey, if I give back one MMRB, how did that do as compared to 2 MMRBs? And then you realize, look, at the smaller I make that box, as long as I have a way to get back in on a resumption of the primary trend, as long as I can get a re-entry, that's the key to sanity. That's what allows you to manage an exit, and then immediately, if it reverses, so you went up and you exited, and then it goes immediately right back up and you get back in, that says, I don't feel stupid for doing that. I'm just executing my rules. Because what you don't know in that little scenario is how much time it's going to take from the moment you exited to the time you get back in. So just imagine a world in which you exited here in time. You made that decision, and then price did nothing but drone along right in here like this for 5 hours. And then it made a move. Where would you want to get back in on that move? Well, the emerging dragon entry would be here because it took out the previous peak of the RL10. So if that took 4 hours intraday or 4 days, then and then you saw yourself getting back in right here, you would say, oh, well, that's okay. I waited to see evidence that the next powerful move was happening. I didn't get chopped around in the noise, and at least I preserved the move that protected me against that return. So I feel very professional. Yeah, but what got you in was the condition that it made the price level that signaled the upward move could be happening. Well, you didn't know at this moment that it was going to take 4 hours. So instead of 4 hours, what if that happened 4 minutes? And that condition occurs, and now you get a re-entry 4 minutes later or 4 seconds later. Is that suddenly stupid? Because you should have known that thing was going to, you should have known reliably that was going to happen in 4 minutes. You cannot possibly know that unless you have mastered the art of seeing the future. So if you would personally feel professional after waiting 4 hours to re-enter because the price condition that you established was met, then you must learn to feel the same degree of professionalism that comes from waiting 4 hours to come out of waiting only 4 seconds or 4 minutes. Because what makes you professional is that you established a price level that would get you back in based on price action, and that you responded immediately when that price condition hit. That's what makes you professional, not your ability to anticipate that it was going to be 4 hours before it did that, which you cannot do. So, for Griff's personal professionalism, his written trading plans, and the exit that makes him feel satisfied and confident has to account for that very real psychological pressure on professionals who are all the time making that trade-off decision in a way that allows them to stay in the game, to protect open games, and be ready to respond to changes of condition to get right back in when the patient responds. And now he's got to be trading in sample sets that allows him to do the statistics on a standard set of work so that he has a reliable population to be able to draw conclusions from, not individual, isolated, unique cases. He's got to trade in samples. And then rigorous assessments of his own trading and with my help as a coach. And then using his trading learning journal for double loop learning so that he learns from the trade that he just took by looking at himself, and then learns from me coaching him or others coaching him, or looking back at his own trade through his own coaching lens. And then as he progresses forward in time, he can come back to that, and now he will see more things about his old trades because of the increase in skill level that he has. He now knows some things when he has that much skill. He can come back and see more things from his earlier trades that he didn't even see before. And that's what we mean by double and triple loop learning, is that unless you have committed to that training journal and going back and revisiting it, then you're missing the opportunity to get the maximum learning value. Now, some additional things, questions to answer for himself. He will be learning to add to his standard work how to integrate market and sector calls into the target selection. Because now that he's adding things like multiple metals and these international indexes and maybe the energy of Devon, how does he use market and sector to help him select the movers? How can he use the idea of green, yellow, and red zone and framing targets? And I showed you a little bit of that already, that at the simplest level, if you have an RL10 channel that looks like that, you automatically know that everything north of that is the green zone, and you want to be long, and everything south of that is the red zone, and you want to be short, which by definition means that this is the yellow zone and it hasn't declared its directionality yet. Can you trade in the yellow zone? If and only if your MMRB gives you 4 segments inside that channel. If there are 4 segments in that channel, then you can trade inside the green zone or inside the yellow zone by simply saying, I could enter there with one MMRB risk box, knowing that if that fails, I'm going to collapsing dragon. But then I could trade that on the way up, and then if it hits the previous resistance and comes back one MMRB, I can get out, and then I can still have enough room to collect 2 units of reward for the 1 unit of risk. Then and only then can you trade inside that channel from the peak of the RL10 to the belly of the RL10. If that channel is less than that, you cannot trade in the yellow zone. You have to wait for the breakout of the collapsing dragon to the south, or the breakout of the emerging dragon to the upside. So now what you're doing is framing and reframing, knowing where the green zone is, knowing where the red zone is, and then knowing the boundary conditions of the yellow zone. And is it wide enough to trade inside there, or do I have to wait for the breakout? And then when I look at those green and red zones, where is the reasonable target if it does break out, so I can determine if I have at least 2 or 3 MMRBs in that direction. And if you're using the R10 or the R6 and you've identified the yellow zone as one of those, then on the intraday trade, you're going to have enough room to break out. And on swing trades, we can use previous support and resistance and the regression line fractal framework to help us estimate the size of those moves. So that's what we mean by Griff's going to work on his green, yellow, red zone of targets in market. Looking at the percent change of targets and markets at time of entry, so he's trying to find the movers. He's going to try to work on identifying the trend of the day and PSAR flips and linear regression lines to try to get in tune with from the initial opening, is it one of these kinds of days? Is it one of those kinds of days? Or is it one of these kinds of days, which then breaks out? So trying to use these different tools to help us classify for strategy purposes. He's working on hybrid trading to see what's working in the swing portfolio to inform daily targets. So if you have something on daily bars that is just continuing to march, until that price action rolls over and hits the swing exit, you're entitled to believe that that thing might just keep going up, and that the further it goes up, you're going to get more buying pressure as people try to follow the trends, which means that you could have a directional bias on things that are in play on a swing trade, and then that helps you select from among your little herd of typical consistent movers. If they're in a swing trade that's working, you want to prioritize those for intraday trading so that you can do core and turbo. And then by the same token, he's got to learn to feed the bulldog to have daily profit and loss limits and manage the intraday chip stack. I also want to say what's working in the swing portfolio to inform daily targets. That if you have something that hits like a 5DD because it has 5 days lower, and so it's not even a swing trade until it's in play, and now you get that, and then you set up a risk box like this, and then you know that that's your mechanical entry, because if it works, it could get back to the 10-day high, and that gives you a 2-to-1 reward to risk ratio. But then you also know, especially in bear and sideways markets, that if it fails below the previous day's low, that whatever was making this thing fail, this might be the next leg down, and so you want to take that because you'll certainly have a 2-to-1 reward to risk on that failure trade. So here's one where we're not even in the swing trade yet. It's not already working, but it is postured because of the pattern that it's in a critical state and it's ready to make a large swing move in either direction. Well, on the next day, if price actually does take out the mechanical entry, you know that that thing just began what could be a swing. So you might be interested in that as an intraday target in hopes that you luck into the first day of what could be a 3 to 5 swing trade. Can I trade inside the yellow zone? That's where I have to use those intraday trading techniques to see if I can get a 2-to-1 reward to risk ratio just inside that yellow zone. And that is the essence of hybrid trading, our most advanced technique, which blends swing portfolio and patterns with intraday daily targets. That's our most advanced technique, is that we're blurring the lines between swing trading and day trading. And that's what you see me doing with the 30-minute charts. I like to find things that are beginning to swing, and which I can then dial down into a 3-minute chart to do intraday trading. And then if the 30-minute chart is working on a swing trade, I can dial up and then start using daily charts once I've got well started with the 30-minute. So it turns out, in my view, that the 30-minute time frame is a very useful time dimension. Okay, so that's what I wanted to say about Griff's trading plan for 2023, evolving from the basics of pattern knowledge, individual pattern management, into a dynamic set of rules that are robust in all time frames and allow him to do continuous trading and continuous risk management. Well, why don't you just start doing that? Because it's hard to learn the basic foundational skills of blocking and tackling. I'll tell you what's harder than that, though, is trying to do all of this from a standing start. That the Kata 2 challenge establishes a baseline of personal professionalism that are now tools that allow him to expand into this direction and expand into other areas of developing his rule sets. So that's what I want to say about Griff's work. That's what you would learn from him on his learning journey at Ableway Tech on the Kata 2 and Advanced Applied System Development course. In that course, he walks you through how he learned to do the Kata 2 challenge. He learned how to take my systems development rules of how to construct a system that fits you, and he turned that into the Kata 2 system, which has been very successful in the year 2022. He's turned that into a course, how to take the principles to create a very specific system with rule sets that fit him. And I think you're going to find that his rule set for Kata 2 is robust and you could personalize. That's what you learn in the Adaptive System Development course. You learn how to adapt systems rules, and then you learn a specific rule set and a specific executable system. And that gives you the ability to learn how you might want to adapt and evolve off of that foundational work. And I think he's laid out a very nice blueprint for the year ahead. And this turns out to be the little coaching contract between me and him. As I continue to help him learn this stuff, I fully expect to tell him to take what he's learning by doing this and turn that into an advanced course on how to expand into hybrid trading by taking these next logical steps. So I'm already telling him, be prepared to make a course. So that means he's going to have to develop that learning journal and iron out these rules and justify them, be ready to teach them, which is going to help him sharpen his own self-understanding. So by teaching him how to teach, I'm making him a better trader. He's making himself a better trader. I'm just pointing a direction. He's doing all the hard work. He's the one that's putting himself into the fire and then taking it out of the fire and beating on it with a hammer and shaping it into a tool. He's doing the hard work. I'm just giving him a recipe and accountability. That's what we want from a coach. Recipes, accountability, but also teaching you to look through the coach's eye. And that's the final thing that I want to say. That gets back to this idea of double loop learning. That if you just trade and then you get money from that, but you don't learn from it, then you are going to just be subject to the random feelings that you have as you take a set of disconnected trades. What we want to do is perform a trade and then come back and study it. And we want to learn to look through a coach's eyes. And so we want to say, how would a coach look at the game film and then let me learn how to look through that lens so that I could learn to look at my own trading. And then if I have myself as coach 0, and then coach number 1, Griff coaches himself, and then he listens to how I coach him, and then he compares what I said to what he saw. And then by doing that, he's actually learning how to improve his coachability, because I see things in his patterns that he doesn't see, because he's still connected in some way to the performance of the trade. And so he's taken one step out to become his own coach, but because I'm not emotionally connected to the trade, I'm 2 steps out. So by comparing what the 2 coaches say about the performance, he's actually learning to increase his understanding of his systems. Hey, does that coach 1 have to be me? No. As long as you have an accountability partner and you both are looking at those trades independently and then comparing notes, you have the ability to do triple loop learning and improve the coaching lens. That will help you create an emotional distance between yourself, the trader, and yourself, the coach. If you can adopt the coaching mindset, you will have put an emotional boundary between you and the trade that you happen to be in, and that actually helps you become more professional because you're not emotionally tied to the trade, you are emotionally tied to the professional rule set. I cannot emphasize too much how important that mindset is for you to learn to become your own coach and to become self-regulating. That is the path that takes you from novice to professional. A true amateur who doesn't even know that you should do that is not even a novice. A novice is the first level where you've learned the rules and you've learned that there are standards that to judge yourself against. As a journeyman, you can reliably do that for yourself, and when you're doing it at a high rate at a professional level, you graduate to become a craftsman and a professional. And so that's the pathway that we want to take to learn how to create standards in writing with written plans, and then learning how to adjudicate and judge, and then self-correct. And when you are self-correcting, you're no longer a novice. You have become a journeyman, and you are refining your craft. That is our pathway from amateur to self-sustaining professional. And that's just a learning path, and you just got to walk those steps. And you're using those standard work to determine, hey, are you on the path? Amateurs get diverted. professionals learn to follow the path in order to plot their course for future pathways. And you see Griff taking this on by developing his own plan for next steps. That's how I know that he has developed the requisite skills to become self-regulating, is because he is self-regulating. And this is my annual coaching commentary to him for doing that hard work. That sets out the annual pathway, and we'll do check-ins on a monthly and a quarterly basis to see how he's doing. So he's got to put that into his trading journal, and we'll see how it goes. So that's what I wanted to say about that. Thanks for your patience. All right, let's take a look at our regular schedule of events. You know, if I was to ask Griff how valuable is that to him, he would say priceless. And I would say, no, there was a cost to doing that. That's the cost of coaching. The real cost is him putting in the time. All right. So here we are with the RL30Z slope sectors, Z scores for the sectors. That's what I was trying to say. And we're noticing that finance, that everything has turned the corner, and we got this COTA 2 pattern that we talked about the last couple weeks beginning to manifest broadly as the market itself went into sideways quiet. Tech is still lagging, finance is leading the way, and XLE is on the way. So Griff, is part of your little reading the market and sector, XLF is leading the way. And we know that JP Morgan has been better than Goldman, but Goldman is starting to catch up. And so you might actually look at FAS and FAZ for as long as finance is in the lead, because that gives you a triple leveraged XLF. FAS long, FAZ short, finance is in play. Energy is beginning to work. Metals and mining are still doing pretty well. But the market itself and tech, so we saw from yesterday's report that tech is working. Semis are starting to make the move, and in the world of semis, NVIDIA was much better than Intel, which was much better than Texas Instruments. So there's some differentiation going on among the semis, and then there's differentiation among the broad Qs and the semiconductor itself. These three are reliable movers, and that's why I've added those to my herd. Okay? So everything looks in position for a surprising move. Because the other thing that we know is that the 200-day moving average has been rolling down, but price, which was at one point 20% below that, has now ground up to the point where it's 0.5% above the 200-day moving average. So it has just begun to cross. Right? Now, the 50-day moving average is below the 200 and starting to flatten out. And when it crosses, then they're going to call that the iron triangle or the iron cross or something, which is really the signal for the upside. So this is early days, and when the 50 crosses the 200, that'll be double plus good. But you can already see it happening in this bottoming action. Notice how exaggerated energy is in its swings. It's so narrowly focused and geared to the price of oil that you get remarkable swings. That's why energy itself is worth a program of routine swing trading on its own merits, independent of the market, although it often drives the market. It's also tradable on its own, which is why I watch that USO XOP as the oil exploration, and then XOM for a company, and then Devon Energy, and then also Clean Energy. So I look at those in that whole energy complex. All of them are derivative of what's going on with the price of oil. I would also add that I look at uranium as sort of the alternate because. So when I look at the energy complex, that's what I'm looking at. Inside the offense versus defense, we just saw the crossover so that XLY, consumer discretionary, is now in charge of XLP. This is another piece of evidence that the market shift has occurred. That this is when XLY is better than XLP, that's in theory a growth moment. Because the discretionary companies are beginning to outperform. So it's more of a measure of optimism in psychology. So this is a market that is finally wanting to make some gains. Everybody's looking at how bad 2022 was, and it wouldn't hurt their feelings for 2023 to be better. So they're trying to find the growth opportunities, and that's why you're starting to see XLY take over for XLP. Here's one from Charles on Merck. So Merck has been just crushing it, but the last 10 days and 5 days have been a sell-off to a baseline, and then had a couple days of recovery. So that gives us this almost Kata 2 style pattern. And if we see this as the solid support, and it didn't fail further here, it's already broken above the PSAR, and then Friday was a great big move up. As soon as that breaks above, he's looking to go long, and that's good with 1 unit of risk. And then you can see 1, 2, 3, 4, just to go test the peak. So before we talked about going from peak to peak, he's even going from the edge of the PSAR to the top, and he's not going to wait to see this break. He's looking at a tighter stop, and he can still get 4 to 1. That's a great intra-channel trade, and if it breaks above this, look out above, because above 116, there is no resistance. That's an all-time high, and then everybody that owns Merck from back in here will be committed to just what you couldn't convince people to sell. There was just that much selling pressure. All those people tolerated that and then continued to support it and started buying it on Friday on a long weekend. So Merck's in great shape. That's an example of connecting longer time frames, sectors, and markets to the individual target. Okay. All right, here's one from Dan. Now, he's doing Intel, and the reason to be interested in Intel was because it had already, on the daily, had made this move. It had come right up into the test of the previous peak, which was the peak on both the daily and the winter. I like the fact that it's got a Kata 2 on the weekly. This one tested. He got the entry and then his risk box here. Now notice that that's inside the noise. So he took the 1 hour loss on that one. A more logical risk box would have been this one. Because until the PSAR breaks, you don't have any evidence that this thing is failing. And so he actually exits in the noise. I could live with a risk box that came to the bottom of the dragon, which is about 0.8 of the, it's 80% of the way down. But in either case, he gets a chance to make that a winning trade instead of a -1R, but it's on half the position size. Because if your MMRB is here, and that lets you get 200 shares, if you double the size of the risk box, you can now only afford 100 shares because you're taking twice as much adverse heat in order to have a constant number of dollars at work. So for instance, if my risk box here was 50 cents and I wanted to risk $100, then I could have 200 shares. But if I put that same $100 at risk and my risk box is $1, I can only afford 100. Same dollars at risk, different size MMRB drives difference of position sizing. Okay? So I still like this one, by the way, since we're already committed to understanding this thing. I mean, I still look at this as higher lows, and so I could take the PSAR box. I would still be willing to take that trade long, and then now I can actually use the PSAR dot as a genuine risk box, and I would just set up the same trade because I think that's going to work from what we've said before when we looked at the semis and the indexes and the market conditions. So I would just keep firing and take that on as information. This is Moderna. And this is that same issue that he had set up this trade box. And again, notice that the box, that you don't get evidence of technical failure until, I could argue, at least the Bollinger Band mean, or the leaving the river, or leaving the dragon, or the PSAR flip. In general, I would say it's better to use the PSAR flip on the hourlies and just accept that that's how much adverse price action you got to see. Now recognize that if he does that, he's still in the trade up as far as here, and then if he takes it where it leaves the dragon or hits the PSAR, he can actually make that trade as a win, and that would be about a 0.5R win instead of a 1R loss instantly. Now, what I want to commend him on is the re-entry that even after this reversal, which got him out at -1, that he was able to re-enter here and still keep a piece. Now, if he'd been able to, so notice how noisy this is. That's why I think even on the hourly, you got to take a look at that as the manageable risk for the 1R loss. You will certainly never take more than a 1R loss that way, but it gives you a chance when it's choppy. Okay, and you can see that when you take this over to the daily, how tightly you're well inside the. Even if you use this wide move, you're well inside the noise because this bottom here is this. So rather than getting noised out and being, getting chased around, just take the wider stop and accept whatever size position that is. It's the technical size of the box that matters. And this thing can certainly go up to 210, so you got plenty of upside room on this. It could easily go to 220 before this is all said and done. Okay. But I commend you on the re-entry. Do we get Microsoft? Yeah, so Microsoft, this is another case where, so this one worked out to have the tighter stop. But again, with his wrist box here, see, I would rather see you at the bottom of the dragon or at the PSAR flip and just accept twice that as the stop. Because look what happens if you just use the hourly PSAR instead of getting noised out. You get this trade on that much risk, and you might have taken that as a second entry on a Z3 pinch breakout. But even if you just took one, you get, instead of a 0.33, you get a 1.0 swing trade on the hourly frame. Now, you're trading this on an hourly. There's nothing to say that we couldn't also have gotten in here on the 3-minute. My sense is you don't want to do that. But if you're just using the hourlies, or even the 30 minutes, I think that wider stop is going to keep you from getting pulled into tactical trading. Because what will happen there is you'll end up watching that thing constantly, but the bar will never move because it's an hour long. And then you're trying to watch the price inside the hourly bar, and that's the hardest way to day trade, is using a really long-term bar and then just watch the price needle moving up and down inside that thermometer. So if you're going to use hourlies, use the wider stops that are driven by, the PSAR flip. And then maybe something like the PSAR trail, you'd be in great shape. But this still looks really good, by the way. It just PSAR flipped Friday. So this thing still has ways that could get up to, 252, which is up in here. So on this one, as soon as that breaks above, I'm long again, instantly. So what kind of a stop would I use on that one with the hourly? I would say, well, here's the belly of your RL10. So if you got long at 240, a $4 risk box. That's the price that tells you that this could be failing back to here. Not until it gets below there, so you have to accept a $4 risk box. Intraday, the R10 on Microsoft is about $1. So if I'm using a 3-minute chart in Microsoft, I could use $1 of risk. If I'm using the 65-minute chart, because of the size of the pattern, I got to use $4. So meaning if I was going to risk $100 on the 3 minutes, I could have 100 shares as my standard load. On 65 minutes, I'd be trading 25 shares, because 4 goes into 125 times. So the choices that you make on time frames is driving the size of the position sizing, because you need to respect the technical signals on the time frame that you're making decisions on, right? Let me know tomorrow if that's not clear. Okay. So that's the frames that were posted. I'm gonna go through a series now of oops, let me cancel that. Yeah, I'm going to take a look at my tactical herd, if you will. And I'm going to go into TC2000, and I'm going to sort it on the column that says reward to risk. So this ratio, reward to risk ratio, on this particular view, this reward to risk ratio is for swing trading. And so it looks at the 10-day high. So every symbol has a 10-day high. On VXX, it happens to be, it's the blue box is the 10-day look back. So I'm looking at a 30-minute chart here. So this yellow box is the size of the 1-day range. So that was Friday. This light blue box gives me the 5-day range. This darker blue box gives me the 10-day range. And then this black box gives me the 30. So the 30-day high is here. The 10-day high is here. So when I'm computing swing trades, I'm just looking back 10 days to the 10-day high and saying, I wouldn't be surprised if this thing had sold off that much. That may be an exaggeration, that if all it did was fight its way back in the next 10 days back to the 10-day high, I'm not allowed to be surprised by that, because the same energy that took it down this far, that the bears are winning, maybe the bulls could take on with their hunger. See if the bears take it that far, now they're satisfied, and now the bears or the bulls come in hungry, that same level of hunger, they may be able to take it right back up to the 10-day high. So I wouldn't be surprised if that critical state leads to just a retest of the 10-day high. That's my psychological hypothesis here, right? So what I'm going to do is simply take the 10-day high as my reward. And then I'm going to say, what if I just used, for standard practice, yesterday's or Friday's range box and just call it the yellow zone? That's why I have that listed or shaded as the yellow zone. Check or hold. And if I just said, what if I used a breakout from yesterday's price as the green zone? That would be the region where I want to be long. And if it broke below, that would be the region, that would be the red zone where I want to be short. So I'm just using a simplified green, yellow, and red, and I just call that the mechanical frame. So if I use the yellow box as the risk, I can now use that as a standard unit of risk and say, how many of those in this to the top? When you do the math, it's 4.4 in VXX. And all I really do is show the reward to risk to the upside, because the fear is harder. If this thing collapses, I know that whatever that was, there could be another one of those on the downside. Whatever reasons made this thing fail are still in play. If it keeps failing, then all those reasons are still in force pushing it down. So I don't even have to know why. I just need to know that they've been winning. They could keep winning. There's momentum to the downside, and I trust the momentum of fear. That you think you're afraid now, you haven't even seen fear, typically. It comes in waves and stages. Whereas courage, which is what allows you as a little field mouse to venture out to get the cheese, is a very fragile thing. And that's why it's normal out of a compound critical state like this to see very tentatively working way up. But if it fails big. And so it's not symmetrical. That's why the collapsing dragon is what we love. And if you just looked at this chart, collapsing dragon, fail. Notice what happens when this little tentatively comes in and then fails through the collapsing dragon. Collapse. Oh, it didn't fail until it got to here, and then collapse. And when that collapsed, fail. And when that failed, fail. Ladies and gentlemen, the collapsing dragon. You don't even have to know anything else except that. Here's another one. Collapse. Here's another one. Collapse. You can do that 1,000 times. Now, on the other hand, notice the behavior of price to the upside. If this doesn't fail here, it grinds, grinds, collapse, grinds, collapse, grinds, collapse, grinds, collapse, grinds, collapse. Failure to follow through is information. When that rolls over and the piece are... Now, notice what happens. Notice where the pocket is. There's your collapsing dragon. Here's where it rolled over in the peak of the RL10. Here's where it crossed the PSAR. This little space inside here is front. That's a pocket entry that is front running the collapsing dragon. Now, the size of this little pocket was almost insignificant. But over here, from the edge of the dragon down to the collapsing dragon, this is where the pocket is. It's still monkeying around. So if you got short here, it hasn't started the big collapse yet until it actually breaks below the official collapsing dragon, and then that collapses. So this is a little bit front-running the collapsing dragon. That is the official confirmation. In my view, you are more justified in taking pocket entries short than pocket entries long, because the collapse happens faster and bigger. Notice what happened here. This little pocket, it couldn't even get to the PSAR and then failed immediately. So that's an example of like a front running an SSC and then it fails. You got to get out of that immediately so you can get that. So these are very speculative front running, but you do not have any trust or belief or confidence in that particular one. You know that once in a while they will go, like this one went. But when they don't work, that failure to follow through, that's telling you what's going to happen. So think back to that previous discussion for Griff. So back to here. So what I'm doing is I take my tactical set. This is about 50 symbols. And 95% of my trades come from that just subset of 50. So it's a mix of broad indexes, sector indexes, individual targets that are connected in a logic chain. You know, the SPY versus the globals versus emerging markets in the globals, which are a more violent form of globals. These are, EFA is the large cap Euro-Asia. There's a IEV, which is just the European 350, and then there's an Asia less Japan large caps. And then from the S&P, you know, I can look at IWM, the small caps, or I can look at the Qs as the tech. And when I look at the Qs, I can look at XLK, S&P tech versus the Qs, and I can compare that also to the FANGs. Which is the uber large caps of, you know, Meta, Google, Alphabet, that kind of stuff. So there's really three forms of tech, of broad tech. And then in tech, I can go to the semiconductors. And from semiconductors, I can go to the three that I care about: NVIDIA, Intel, and Texas Instruments. Now you could also, if you wanted, add AMD and Applied Materials and all that. You could get as specialized in that as you want. I just want to get three movers, so that if S&P is working and tech is better and semis are better, it may be that one of these three is even the best. And so I can quickly follow the logic chain to get out there. In the same way that I can look at XLB, materials, and I can split that into XME, metals and mining, or I can go over to the combination of cut and wood as two lumber ETFs. And then metals and mining, I can look at Cliff, Alcoa, and U.S. Steel. And if I look at finance, I can look at FAS, FAZ, JP Morgan, Goldman Sachs, Visa, Bank of America, So I can find ways to get that done. If I go to energy, you can, what I showed you before. So when you take a look at all of these things, that's the logical diagram that puts them all together. And I have other things in there like EWW, EWZ, lithium, Tesla, Rivian, because I want to compare something to Tesla. Wheat and precious metals for gold. I have IYR for residential real estate, and Simon Property Group as a proxy for commercial real estate. I have XBI for biotech. I have the two ARC Innovation and ARC Genomics to get the fanboys for high-tech growth, and Kathy Woods to play one way or the other. So, and then treasuries is an alternate to all of that. So as I assemble my tactical symbol set, or in my boot camp as I call it, there's 50, and that's the one that when this is dynamic, I can see, and I sort it by percent change, I can see the best performers and the worst performers. And then I can, so if I do that, let me just do that. I can find the actual, when I'm managing it intraday, I can just find where's the cut line of things that are working versus not working. And then where's the S&P as my baseline. So if the S&P is going up, I want to be in these because they're all going up better than the market. Hey, there's XLB. And there's Alcoa. You know how quickly I can go from market up to materials to Alcoa and find Alcoa and trade that? Faster than I just described it. Because I can sort it this way, find the S&P, and then read down. Where are the movers? There they are. Oh, Alcoa and NVIDIA, instantly go to them. Done in one. Hey, this is interesting. Alcoa was up here and U.S. Steel is down here. I don't mind trading U.S. Steel short because there's real reasons for people shorting U.S. Steel. I don't know what they are. Don't need to know. I just need to know that a bunch of people that own U.S. Steel are selling it in a day when the market is up and materials are up and Alcoa is up. What is going on? So that tells me there's something special in the sell-off of U.S. Steel, so I can participate in the momentum to the downside, and when it bottoms out, maybe I can get an SSC and then some COTA 2s as it recovers from the over-exaggerated selling. And that's all I do. Find the movers using my little stack of 50. So now what I'm doing is taking that same set of 50, and now I'm ranking them by reward to risk ratio for the swing trade and displaying it on a 30-minute chart. And what I'm looking at is the reward to risk ratio is defined as the 10-day high as the price for reward, the mechanical entry for risk, consisting of, if I got long automatically here and 1R and then short here on a failure, then that would be my 1R. So that's my risk, my mechanical risk. This is my mechanical short. This is my mechanical long. Can I trade inside the yellow zone if I can see a 2-to-1 between the red and the green line? Meaning that I would have to have, whatever my risk box was, I have to have 4 of those inside here in order to justify that. That might be it opens here, it doesn't sell off, but starts to move straight up. I can get long here. And then I have a hope of getting 3 intraday units of reward. And then if it goes through that, that's where I would pick up the swing trade. And look, I can fund that with the money that I made on those 3. So the combination of intraday yellow zone trading plus mechanical swing trading is what creates hybrid trading, which is what Griff is learning to work on. And I've got, if that's my unit of swing risk, I've got 4.4 of those back up to the reward, which I know because of the reward to risk ratio computation. Hey, I'm showing this on the basis of my 50 tactical symbols. Here's what's nice about TC2000. I can just go to the S&P 500, and now I'm collecting 50, and now that was the index. I could do that. I could do it on the S&P 500. BAX is 9.7 to 1. Now, I can look at that and instantly say, I love this as a mechanical swing trade. It's had 5 days after the sell-off. It's had 5 days, and it never failed further. That is information. In fact, it's had one little push up, and that failed. Second little push up, that failed. But it's still holding, so now it's in a range compression. How compressed is it? Well, if this was my standard unit of risk, there's 9.7 of those up to the 10-day high. What if it only got halfway up? Well, then that's a 5-to-1 trade. And guess what happens on this one? See this little peak RL10 right here? If I were to get long right here and it gets up to 1R, you can tell by inspection that's 1R. And that's been the lid. If this breaks out from here, there's no resistance in there at all until it gets up to here, because this was all of a gap. So if it breaks above this price, 46 and some change, it's going to close the gap. Now, how fast is it going to close the gap? Well, it moved that far in one day. It moved that far in one day. It might go like this. It might take 2 days. But if it gets to here, I've got a 4 or 5R trade in hand. So this is a low-risk idea. Why? Because if I set this up as a long here and a short here, what if it opens here and just immediately fails? Would you have any compunction about getting short there? You shouldn't. Because this is resuming the pain and suffering that caused all of this. Why? Because previously that support level held, but now it didn't hold. That means the bears are coming back hungry for more, and that's the beginning of a new trend. How big could that be? The size of the previous trend? I just clone that and say that's how far it could fall for reward to risk purposes. So when I have in the mechanical reward to risk an enormous payoff, I don't even have to worry about, is there a justification for that failure? I've already seen the justification. Plenty. This is the one that I'm interested in. How many of those to the upside, just to the 10-day high? So the reward to risk ratio is a mechanical entry, mechanical risk, standard work computation, just for approximate sizing of the opportunity with which I can rank all of these other ones. So if I really like that, we think of this as a max pain range compression, and that's the I'm going to present this to the Society for Technical Analysis in February, and they're going to love this, because this is easy, because I can I can do that on the S&P 500. I could go to the NASDAQ 100 and find Pep Boys, perfect. Hey, it was supposed to fail Friday, but it didn't. In fact, it held and made some upward moves. I don't even have to wait for mechanical entry. I could just get long there and then reinforce if it gets here and reinforce if it gets above there and just all the way back to the 10-day high, and it's 4.2 to 1. I could look at the, you tell me what you want to look at. The high cap 1,000. So this is the Russell 1000, the largest 1,000. There's LOGI, perfect. There's Bax, Booz Allen Hamilton. If I go to the other extreme, these are the ones that are the strongest, because they're already at or near their 10-day high. So I can find the relative strength leaders. I just like the discipline of the max pain range compression, because I believe that the big sell-offs are more likely to be the result of an emotional reaction than guys that have climbed this hill carefully. It's that fear overreaction that is stabilized, which is what I like. So what I really want in max pain range compression is the largest possible sell-off from the 10-day high to the current price, combined with the smallest possible daily range. So this would be twice as good if the daily range had only been this, but it was this big. But still, that's 9 to 1, 10 to 1. But if it had been only this box, it would have been 20 to 1. So what I like about TC2000 is it gives me the standard markups, and it lets me very easily construct. Like if I went to the world of thousands of ETFs, you'll see some, there's JJS, what's it, soft. So that's the consolidated index for all the soft commodity contracts. They're at a natural low. So if I'm a futures trader, I could do that. So this is the power of the TC2000 to rapidly find things. I could go look at Canada. I could find S&P 100s. So if I wanted just that, the top 100, right, that's the OEX. Abbey V Inc. Perfect, ready to trade. Those are all very liquid. Hey, there's Johnson & Johnson. Nice. 4 to 1. And now I've got all these other computations. The R10 is 30 cents. The R3 is 60 cents. You know. The size of the intraday, the range stat divided by my risk is 1.6. So I can start figuring out how big the yellow box is relatively. It gives me some other stats over here for what the 10 bar, I can find the 10 bar high, reward to risks, R stat over here. So TC2000 is a powerful way to do all your sorting and scanning and coding and judging. And you can see I've got the 4 seasons of MACD posted in here, the color coded RL10 to help me see where things are. So I say all that just to set up, going back to my personal lists. Like I like this XLP components. If you took the S&P sector XLP, which is all those consumer staples, I can break that out into just those components, and I can find the ones that have been doing the best or the worst. So GIS, General Mills, is horrible, and the one that's been doing the best is Brown-Forman and Clorox on a 10-day basis, right? So Clorox is actually the strongest in XLP. There's Walmart's in the middle. So you could specialize on this as much as you want. You can look at industry indexes. Every one of these is that's the technical name for broad indexes, tobacco, medical distribution. So you can be as specialized as you want. So I'm going to go look at personal boot camp. That's just my tactical set of 50. Just so I want to be clear on that. And I'm going to sort it by reward to risk ratio because I want to simply look at the ones that offer me this my favored default pattern, which is max pain range compression. The way you get the highest reward to risk ratio is the largest sell-off divided by the smallest risk box. So VIX, and I'm just going to quickly scan through these so I can note the ones that are interesting. I like agriculture DBA because it put in 2 days of recovery after significant sell-off. XLP, nice. Microsoft, that's actually pretty good right there. It has already had 2 legs on the long side and is ready to go. Brazil in great shape. You can see that I had on Friday closed the swing trade that I entered from here on the 5th on a COTA 2 with that much risk down to the dot, and then closed up here on Friday because I didn't want over the weekend risk. Plus it broke through the PSAR and cashed. Marijuana, I like it. Look at that range compression, ready to buy it. Texas Instruments, lithium. So there's very few that are going to have favorable reward to risks because the entire broad market itself has been on a recovery up into sideways normal. So there's not a lot of things better than 2 to 1. In fact, there's only 3. XLP, agriculture, and VIX out of my favored 50. So I got to be more interested on the breakouts to the upside. So I might reverse that and look at the ones that are the biggest winners. Aussie dollar, and now I'm going to bring this out further so I can... Now, if I looked at these on a daily chart, I would also see the same kind of sensibility, right? If I go back to the VIX, notice that's what the VIX looks like. At the bottom end of its 10-day high sell-off and this little compression, but that's part of that volatility leaving the market. Agriculture. XLP. And that's the point I want to make about this market. XLP is the 3rd best reward to risk ratio to the 10-day high, and it's already looking pretty strong. Microsoft in good shape. Is there any wonder that I like EWZ? This breakout to the upside, it's already in a COTA 2 and it's going to continue. Now I can start saying, instead of just targeting the 10, I can target the 30-day high or the peak of the RL10 or the peak of the dragon as upside targets. So now you have a adaptable framework in which to start framing these swing trades across the board. And I love marijuana right there as a trading vehicle, not as a device. Texas Instruments, lithium, Tesla, love it. That's failure to fail further so far. That's tentatively to the upside, and it just PSAR flipped. So if you're not ready to own Tesla to the upside, then you're not really a swing trader. You're something else. Now my swing risk box should be, there's my little, should be down here. So although that is my mechanical 1-day box, if I'm a swing trader, I should be here because of that dot. So I got to actually have two of those daily boxes. But that gives you enough wiggle room for this thing to finally make its move. And that's about $12. Okay. So that's our, you guys have been hanging in there. We're at this for 2 hours. That gives you an idea of swing framing and some ideas on hybrid trading. That was a hybrid trading workshop in 2 hours. So there you go. Have a good weekend, and we'll see you tomorrow.